Okay. And I just want to take a look at this slide talking about predetermined manufacturing overhead rate. And remember, we said that when we come up with the predetermined manufacturing overhead rate, we are going to sit here and come up with our estimated total manufacturing overhead for the period and divide that by our total estimated units that we're going to produce. I think we should come back here in a second. Okay. All right. So we're going to sit here and we're going to be looking at our estimated. It's gone again. Okay. Now we're back. Okay. So we're going to look at our estimated total manufacturing overhead and divide it by the estimated total units. Remember that? And remember we said at that time that they would maybe be coming up with these estimates, say in June, July of the year preceding the year that they're actually going to use the predetermined manufacturing overhead rate. And we said that we would use a method called the high-low method to come up with the equation for our cost line. And remember, our total overhead was going to be this line here that was being pushed up by our fixed cost, and then there would be the slope to this line, which would be our variable cost, our change in our variable cost for the period, right? Okay, and so we went ahead and we took this notion of total cost is equal to our fixed cost. That's the y-intercept of that line. That's where it comes up above 0. It starts going horizontally across the chart there, right? That's our fixed cost part. It's going to be the same regardless of the level of production. And then we would set that equal to our variable cost times the number of units. Remember that whole thing? Okay. And so we plugged in a number there and came up with what our total overhead costs would be. But we used, in the example, the high-low method, where we had a series of observations that would have happened. And again, the only reason they're putting up to June here in this example is they didn't want to have 12 months and have a bunch of information on this page, so they cut it down so that it was just June. The more observation points you have, the better. And so they went ahead and they looked at the difference between the high point and the low point on these observations. So in effect, if you were thinking about that chart that we had a minute ago, and they sat there and they had this chart, right? Okay, there's our fixed cost, and all they were doing was essentially saying, well, we're going to take the high and the low point on this chart, and we're simply going to assume that all the observation points line up along this line. Do they really? They don't really, but this is an approximation, isn't it? If you just take two observations and put them, you know, a line between them, you're basically fitting a line to the various observations for your number of units and your total cost. So they use the high-low method, and in this example, they simply, let's go ahead and figure out the numbers here. 9,800 minus 7,400 is a change in the total cost, change in Y of 2,400, and change in X, the number of units, or the number of hours in this case, of 400, observing the high and low points here, right? Okay, and so we went ahead and we came up with a variable cost per unit of $6 per unit. And once we had that, we could figure out our fixed cost. And all we had to do was take, and we could use either the high or the low, take our high cost observation, total cost, and subtract off the variable cost at the high level of activity, $6 per unit, times our 850 hours. And that's going to give us a amount for our fixed cost here of $4,700. Once we have that amount for our fixed costs, now we have a cost line for any level of activity, right? And all the company has to do is plug in this level of activity, the level of activity that they think they're going to have, and that's going to tell them what their total overhead costs will be at whatever level of activity they anticipate having, and then they would divide that total estimate by what? The total estimated amount of activity, and that will give them the predetermined manufacturing overhead rate. And of course, they'll use that predetermined manufacturing overhead rate to apply overhead to the jobs. Remember, we have to apply the overhead to the jobs. We also apply the overhead and process costing from department to department, right? And we talked about that in chapter 3, and in chapter 4, this all ties together, right? In chapter 4, we talked about how we could have multiple overhead rates, and there, when we were coming up with the multiple overhead rates, we were talking about possibly doing them by department, right? And we would go through a similar process for each one if we had multiple overhead rates, okay? So I had put this problem up, and I know it's a little hard to see. It's in chapter 2, and you're definitely going to want to take a look at it, but it's the high-low method. And guys, since I am going to give you a problem now, it turns out with the high-low method, I'm going to advise you to bring a highlighter with you to class. So if you're looking at a set of observations, it's easier to highlight the high and the low. Okay, so what is the high level of activity? Can you see it? High level of activity? 520. Okay, good. And I have my high overhead cost at that high level of activity, right? How about the low? Low is 300 here. There it is, 300. Okay, and I like to highlight them when I look at these questions, so then I don't have to keep going back in there and wasting time. Which one was the high? Which one was the low? That's that's the trouble I had. To me, that's the hardest part of these, is finding the high and the low and then pulling them out of the problem. Okay, so what happens? I'm just going to take that 470, and we went through this before, right? I'm just reviewing this just because I think I had a different expectation in your mind before, so you might have slept through this. Now I'm telling you, it's going to be on your test. 470 minus what? 2820. That gives me a difference of how much, guys? 4470 minus 2820. I know you guys, you got bit by a calculator when you were little and you don't like to touch them now, huh? 1650. Okay, so we got 1650, and we're going to divide that. That's sort of like the change in Y, right? The change in total cost. And we're going to divide that by the change in X, which is going to be 520. 520 minus what? 300? And what's that, a change of, 220? Okay, and when you do that, you get what? 7.5? Okay, good. Once you get 7.5, then you can sit there and you can figure out your fixed cost, right? Okay, and the way you get the fixed cost is going to be to take that 7.5 times, and you want to use the high or the low? High, okay, so that's going to be times what? 520, and we're going to subtract that from the total cost at the high, which is what? 4470? Okay, so 4470 minus 750 per unit at the what? And we're doing all this at the high, aren't we? Right, so that's 520 units. What do you come up with as a difference here? 570? 570, then that must be the fixed cost, right? This is my total cost at that level of activity. This is my variable cost, 750 per unit times the number of units. Difference got to be what? Fixed cost, right? Okay, and now the company would be ready. They'd say, okay, at whatever level of activity, and they chose 420 in here, we would set that up as what? We would set that up as 750 times, in this example, what? 420 plus the, 420, not $4.20, 420 units. 420 plus the fixed cost of 570, right? And what we come up with this answer here, 3720 is their total estimated overhead cost for the next month or whatever at 420 units, right? Okay. Now, what's the predetermined manufacturing overhead rate? What would be this company's predetermined manufacturing overhead rate? We know what they're anticipating the total costs are going to be, right, at this level of activity. So what's the predetermined manufacturing overhead rate? Who wants to set that up for me? Right here, guys, look. My total cost is how much? 3720, right? At the 420 units of activity. So would my predetermined manufacturing overhead rate be 3720 divided by the 420 units? Right? Predetermined manufacturing overhead rate is what? Is my, just go back to where we started this whole adventure here, is what? Is my estimated total manufacturing overhead divided by my estimated number of units, right? And I'm just showing you how to use the high-low method to come up with these numbers. Okay, so what was it in the problem? What's going to be in the numerator? 3, what was the total? Total cost, somebody look back. I'll do it. Come on, guys. You got to kind of stick with me here now. What was the total that I had here? 3720. How do I come up with it? Using the high-low method. So I'm going to take the 3720 and I'm going to divide it by what? By the 420. That gives me what? Something like 8 something? 8.85, you say? 714, give or take? Okay. Right? Right? Now, let's say their actual number of hours here was 400. Who wants to give me the manufacturing overhead applied? Come on, I've set it up for you. I apply it based on the actual number of hours of work. Remember what we're trying to do here. Remember, overhead is something that we can't trace directly to our jobs, right? So we have to have a predetermined manufacturing overhead rate that we use to apply that cost to work in progress, don't we? Isn't that what we were doing before? Okay, so if I have what? If I've spent an actual 400 hours, what is the amount of manufacturing overhead applied? 9.3, you are taking 8. Something sounds wrong with what you said. You're taking 8.85714 and you're multiplying that by 400? No, we have to multiply because we're going to apply our overhead based on the actual number of hours we've incurred, right? Right? I'm glad we're not taking the test tomorrow. So 400 times 8.85714 is how much? Say it again. 3,542, you say? 0.856. Okay, good. What do you want to do with that number? Well, okay, just assuming we're okay with the rounding, 3, 5, 4, 3, whatever. But what do you want to do? What debit credit are we going to do with this number? We have these numbers. Accountants have numbers so they can debit and credit them, right? It's going to be a debit and a credit. If it's a debit, then it has to be a credit. Okay, so what do you like better, debits or credits?
Depends on what side of what type of
Okay. Some people say I like debits better, and the credits heard about that, and so that's when they created credit unions. Okay, everybody.
So wouldn't that number be?
That was a joke. Okay. You know what? When you guys tell jokes, I'm not going to laugh at them either someday, okay? I'm not going to laugh. I'm going to sit there. When you're a comedian, I'm just sitting in the front row, look at you, not laugh. No, just kidding.
Would that be a credit to work in progress?
Well, you got the right account. You got the wrong. That's a debit to work in progress. Good. So what am I going to do? I'm going to debit my work in progress. 3, 5, 4, 3, I guess. Just around it. Right? And I'm going to credit what? So we got the debit. What am I going to credit? No. Okay, accounting is not a creative thing, okay? Accounting isn't one of these things that you're sitting there and you're painting a picture and you go, there's not enough blue here. Let's put some blue, okay? So, you got to sit there and you've got to know which brush to dip your color to dip your brush in to make this beautiful painting that I'm trying to make. Don't insult accounting like that. So what happens? What are we going to debit? Huh? Well, are we going to credit? We got the debit. What are we going to credit? We have to, raw materials, please. We have to what? We have to apply the manufacturing overhead, don't we? Wasn't that the whole point? So we credit what? We credit the manufacturing overhead what? Applied, and applied is on the credit side, for, what was it, 3154? 3543, I should say. There's the debit to work in progress because we have to apply it to the jobs, don't we? We don't trace it directly to the jobs. We apply it using the predetermined manufacturing overhead, right? Which we came up with using the high-low method, right? Right? Okay. So what would be the debits over here? What's the debits over here? Where would the debits come from? From their mothers? The debits come from debit land? Where do the debits come from? This is the actual overhead, isn't it? Anybody got any examples of overhead items? Huh? Huh? Utilities, good. Utilities. Whatever, for 1,000. Got to pay that utility bill, don't we? And we can't trace the, electricity to each item. How much electricity did this one use? So we're applying it to work in progress, right? Property tax, your favorite. I'm saying your favorite because I think you've mentioned it a couple times now, right? Okay. So that's 500. Then we'll make it 1,000. I want this thing to go on and on. Any others? Indirect labor. $1,000, okay. Anything else? How about, Depreciation on the factory equipment. Good. We'll make that 600. How's that? Okay, well, yeah. Rent would be if we had rent, but I want to stop because I don't want to keep writing. But yeah, rent. Okay. All right, good. So we have the actual over here, don't we? Is this overhead under or over applied? It is under applied by what? $38? Under applied by $38? Okay. By the way, while we're making these debits over here, what are the credits going to be to? We're making these credits. What were the debits to? No. No, these are all balance sheet ones. Everything that's I'm asking for a debit here is a balance sheet. I mean that I'm asking for a credit. These are the debits I'm asking for the credit for is a balance sheet. Cash, if we are paying the utilities, I guess, with cash. I guess. So we would have debited what? Our manufacturing overhead for $1,000. Well, I'm going to do the whole amount. We would have debited the manufacturing overhead for, what is it, 3,600. There's that debit that you see up there, right? And then I would have done what? I would have had to have credited. And Steve, you want to say cash. I'm thinking cash then for the utility bill of $1,000. Or it could be utilities payable, right? Right? For the supervisor salary, the indirect labor, I'm going to go ahead and just so that we see some variety here, credit salaries, what? Payable for 1,000. How about for the depreciation on the factory building? I'm going to credit accumulated depreciation, right? For, what is it, 500? 600? Okay. And what do we have the other one here? Just because I'm an accountant and I can't bear to write a journal entry that doesn't finish. What's the other part? The property tax. Okay. Property tax payable. For how much? 1,000? Okay. And so we have that journal entry there, right? Right? We would have also debited, I'm showing you the whole journal entry up here on the board now, debited work in progress for the applied amount, which is what, 3,542? 3,543? 543, and I would have credited the manufacturing overhead applied for 3,543, right? Credited it for 3,453, debited the WIP work in progress, credited the manufacturing overhead applied for 3,453, and so if I have the manufacturing overhead teed up here, just like I have written on the screen there, I have on the debit side now 3,600, and I have on the credit side this 3,543. Am I under or over applied? Huh? I'm under applied by how much? Huh? $57. Okay. So I'm under applied by $57. So what do you want me to do here? Well, look, do I want this to be 0? I want this to be 0, don't I? Because I keep track of my overhead by year. Right? And so what happens? I know I have to credit this for 57, don't I? My manufacturing overhead has to be credited for 57. What do you want me to debit? Cost of goods sold if it's not a big deal, right? If it's not a big amount, 57 bucks, might be able to put it all in cost of goods sold. Like I was saying in class, if I was auditing you and I felt that was a large number, I would ask you to allocate it appropriately between work in progress, finished goods, and cost of goods sold, right? Okay. Okay, so we'll be reviewing this some more, guys, as we get into the tests. And all I wanted to show you was what? Review with you the high-low method that was used to come up with this predetermined manufacturing overhead rate, right? But then we talked in detail in Chapter 2 about all this part. And I know it's been a while, and we've talked about some other things since then, but, you know, we're going to have to start to get ready to get that stuff down because you will be tested on, you know, some pretty tough questions like we looked at in Chapter 2, expecting you to be able to go through this process, right? Okay? Question? Okay, good. So I can get out of this review of Chapter 2. I don't know why they tied this thing. See how they tied this onto here? so that now it creates a little jump rope thing. Maybe they said, hey, that accounting 101B, business 101B guy's a little heavy. Make him do some jump rope during the class and tie that to the thing. I'm not sure what they're trying to accomplish there, but anyway. So if I fall down, you're responsible for picking me up. Okay. That's a tough job I'm giving you, huh? Okay, good. So we're done with that, and let me go ahead and close that guy out. Don't need to save that. And I want to get us into Chapter 5 now. Okay, so let's just go ahead and turn our attention to Chapter 5, and let's start to talk about cost, volume, profit. They're saying relationship, whatever. Cost, volume, profit analysis. Okay, cost, volume, profit analysis is the way I like to phrase this or call this. Okay, now what happens with cost, volume, profit analysis? Let's say you want to go into business. You want to go into business, and why would you go into business anyway? To make money, right? Okay. That's the whole thing. Okay, we make money. Why do we want to make money? To buy stuff, to get stuff, right? What happens? At one time we would make something and then we would do what? Give it to the other guy and he would give us something back. That's called barter. But at some point we created this idea of what? Money, in which we would do work or we would make stuff and sell it to somebody else and get money, right? Okay, so we're doing this. We're going into business because we want to have money to buy the things we want, right? Do you want a big house or a little house? You want a big one. Why does everyone always have to think about that? You want people to walk in your house and say, you don't need a house this big. How come you have this big of a house? And your answer to them is what? Because I want it. That's why. No, I don't need it. I want it. Okay? All right. So whatever. Same thing. Same answer. Okay? So what happens? We need to make money. And so you're going to try to go into a business and you're going to want to make a profit, aren't you? But before you can make a profit, what do you have to do? You have to at least break even, meaning you have to do what? You have to cover your cost, don't you? Okay. Now, when we look at cost, we look at them in terms of variable cost and fixed cost, don't we? Okay. So what happens? Variable cost changes with the number of units that we produced, right? So if we produce more units, we have more variable cost, don't we? So we're going to see that we're going to set up a situation where we first consider our variable cost, and then any amount over and above our sales price off of our variable cost is left to cover our fixed cost. And then once we cover our fixed cost, now we can start to make a profit, can't we? Or start to have income. Okay, so what's going to happen? If you think about that, you can set that up to say, well, I have my sales price minus my variable cost. Now I have something called, and this is going to be the big phrase for the day, contribution margin. That contribution margin is what's left over after I've covered my variable cost to cover what? First my fixed cost and then my profit, which is the reason I got into this whole thing anyway, right? Okay? Okay, good. So you take a look, and that's what we have here, this idea of contribution margin. And contribution margin is used to cover what? First my fixed cost, and then what? And then my profit, my operating income, however you want to phrase that. But first fixed cost. Covers that first. And then what? Then my income, my profit, whatever you want to phrase that. Okay, so that's what we're looking for here. And you can see that when we come up with our contribution margin, we are simply going to take our sales price minus our variable costs. So if we sell an item for $10 and our variable cost is $7, our contribution margin is what? $3. That's the $3 that we have left over from that sale after we covered our variable costs, because we got to cover those for each unit we produce, right? So there's $3 that we had left over. Those $3 per unit will first cover my fixed cost and then any profit, right, that I want to make, okay, any income that I want to make. Now, we could also come up with a contribution margin per unit, okay, and we'll spend quite a bit of time with that because that contribution margin per unit is the most useful in our analysis for seeing how many units we have to produce to break even. And we can take that by taking the sales price per unit minus the variable cost per unit will give us the contribution margin per unit. Hello, right? Sales cost price per unit minus variable cost per unit is going to give you contribution margin per unit. Or you could simply do what? Take your contribution margin that you just calculated by subtracting your sales minus your variable cost and divide that by what? The number of units. Both ways will give you your contribution margin per unit, right? Okay. So let's go ahead and let's do a example here. And this is the way I'm advising that you set these problems up every single time. Okay, the reason I like you to set them up this way is I feel that it gets you out of the mode, and the way this stuff is often taught is someone just tells you to memorize that, and I don't like that because I feel that if you set it up the way I'm doing, the logic comes to you when you set it up like that enough times, and then you really understand what you're doing and you're going to be able to do well when we test you on this, okay? So we set up our break-even unit calculation as the contribution margin per unit. That's the amount that's first going to go what? Towards fixed cost and then my profit, right? My income, okay? And then I would multiply that, and the break-even sales is the unknown. I don't know how many units I'm going to have to make to break even. That's what I'm trying to find out. If that number is 100 units, am I encouraged about going into this business? If it's 100 units? Depends on what the units are, but just as a relative number. If it's 10 trillion units, am I excited about going into this business? Okay, so what happens? If that number seems like the number of units that I can actually sell, that's pretty good, right? If that number comes out to 20 quillion units that I have to produce to break even, we better find another way to survive, right? Because we will never be able to sell that many items, right? Okay, so we go ahead and we set that thing up as our contribution margin per unit times my break-even in units has to equal my fixed expenses, right? Because I've already covered my variable cost by subtracting them off of my sales price. Now I'm down to the contribution margin, and if that equals my fixed expenses, I'll break even, right? Okay, so then I just say do the algebra, and this is why the reason I put it this way, guys, is I don't think it's wise to just try to memorize this unit sales to break even is fixed expenses divided by contribution margin per unit. When my students start looking at it that way, then they start asking me, can we have a formula sheet in here? And the answer is no, you can't have a formula sheet, okay? And I don't want you to memorize a formula. I want you to understand that we're setting this up as an algebraic manipulation here. Contribution margin times my break-even in sales in units has to equal my fixed expenses. And then I simply divide each side by what? The contribution margin per unit, and that leaves me with what? The units that I needed to break even, which is what I was looking for in this problem, wasn't it? How many units do I have to produce to break even? That's the way you set these up every single time. Okay? Okay, so let's just go ahead and let's take a look at this numeric example. Okay? And I guess they're selling bikes or something in this example, but I took out much of what the book had as the example, but they're selling bikes. I kept the numbers, but I didn't like the way they were articulating what you did, so I pretty much deleted everything and put this stuff in here. So example, company has a sales price per bike per unit of $500 and variable cost per unit of $300. So every time you make a bike, you got to cough up $300, don't you? Okay, to go ahead and produce this bike. If you don't pay that $300, you don't have a bike. Okay. In this class, we study Accounting 101. We don't study other things, guys. I'm telling you, you're not going to get away with doing work on something else while you're in here. I'm telling you, I'm going to catch you every time. I'm going to bust you out. Okay. So what happens? We sit here. And we have what? We have our sales price of $500 and our variable cost per unit of, by the way, when I'm saying something and I'm looking at you, that means you weren't doing it. Okay, so, someone's like, what? I didn't do anything. Or On's over here, what? Okay, if I looked at you, you're not the one. Okay, so what happens? We sit here and we have what? We have our sales price of $500 and our variable cost per unit of what? $300. That means we have $200 left over per unit after we've covered our variable costs, right? They tell us in this problem that the fixed cost equal 80,000, and we want to know how many units will the company need to break even. So we set it up as our contribution margin per unit times our break even in units has to equal our fixed cost. Isn't that how we set it up every time? Right? Contribution margin per unit is going to go towards my fixed cost, and if I cover that, then I at least know I've broken even. Of course, I'm going to want to make a profit at some point, but let's break even first, right? So the unknown here is the break even in units, isn't it? That's what I want to know. Okay, so I go ahead and I take my contribution margin per unit, which is 500 minus the $300 variable cost per unit in this example. That's $200 per unit contribution margin, right? I then take that $200 contribution margin per unit and I set that up as being equal to my fixed cost when I multiply my break even in units, right? So if I have $300 going towards my fixed cost, how many units do I have to produce to generate $80,000, right? And so I simply do the algebra, which is take the 80,000, divide that by the $200 contribution margin per unit, and if I produce what? If I produce 400 units, I'll break even, won't I? Right? I've got $200 per unit first going towards my fixed cost. I just want to know how many units do I have to produce to cover my fixed cost so I break even. It's the what? $200 per unit times the 400 units will generate $80,000. Have I covered my fixed cost? Have I covered my fixed cost? Okay. Okay, good. Now, if you want to get the dollars, right, because you could say, okay, 400 units, but a lot of times we want to say, well, what are our break-even sales in dollars? Then you simply take the sales price per bike. In this example, I guess it's bikes, times the units you're going to sell. So you'd have to have $200,000 in sales dollars to break even, wouldn't you? Just turning that unit into dollars, right? Okay. Now, just to sort of see how that works out on a, sort of set up financial report here where we're going to see first our sales price, 400 bikes, at $500, $500 each. That's $200,000, right? 400 times 500 is 200,000. What was the variable cost per bike? Variable cost was 300. 300 times the 400 bikes, $120,000, right? So if we bring in $200,000 in sales, we have to cover our variable cost per bike of $120,000. If we don't cover our variable cost, we don't have any bikes to sell, do we? So we got to cover our variable cost, so that's $120,000. What's left over? Our contribution margin of $80,000. If our fixed costs are $80,000, we broke even, didn't we? Okay. Again, the way to set that up, though, so that we don't have to generate a whole financial report to do that, is to set it up the way I just did when we're sitting here and we're going through and setting up our break even in units. And what's nice about this setup, guys, and the way you're doing this, you can do this while you're having dinner with a potential business partner, can't you? Right? You can almost sit here and pull out your iPhone and say, well, let's see. If we do this and we do this and we do that, yeah, that sounds pretty good, right? Okay, and when you're having a meeting like this and you're over dinner, the more wine you drink, the better your plan gets, right? Okay, so be careful with that. Make sure you're staying sober, and I don't mean just physically sober, but sober about, don't get so excited about your plan. You start saying, yeah, well, 10 million units, that's all we have to sell? People will buy our 10 million pictures of us. No. Okay, so, you want to be careful with that because sometimes you get excited. But if this number seems reasonable with what your capacity is, etc., maybe not a bad little thing for you to get into, right? Okay, so this just shows you how it works out here in, a detailed statement where we go ahead and show, and this is the contribution margin format for our income statement. This is not how we report our income statement usually, right? For financial reporting purposes, it's what? Sales minus cost of goods sold gives me gross profit minus my operating expenses gives me my operating income. Then I have to take my non-operating items like interest and those sort of things, and I come up with my net income. Okay, that doesn't lend itself very well to a quick analysis like this when we're trying to make some important business decisions, right? So internally, a company might use this this format to help them to quickly see, what the number of units are, et cetera, that they have to sell to break even. What is their sales dollars? Now, do we get into business to break even? That's not why we get into business. We want to make a profit, don't we? Okay, so what happens? You come over, and it's very easy to start considering profit. All you got to do is say, okay, how much profit do I need in this thing? How big is my house going to be? What's my house payment going to be? What am I going to do? Car payment? What am I going to do? Okay, I need $200,000 to make this whole thing worth it to me. So you go ahead and you add that on to the fixed cost, don't you? Add that onto the fixed cost. Now I'm going to know how many units I need to, as we said, first cover my fixed cost and then what? Leave me over some sort of profit, right? Leave me something to buy the house with. Okay? Okay, so let's just go ahead and take a look as to how we set that up. And again, I like to first set it up as my unit sales times my unknown would be what? My now target profit units, I should say my contribution margin per unit times my target profit units has to equal what? My target profit plus my fixed cost. I divide each side by what? The contribution margin per unit, right? And that tells me how many units I need to sell now to make this profit of 20,000. So we just simply added 20,000 to our fixed cost from the example we were looking at before, right? We still have our contribution margin of 200. Our sales now in units is how much? 500 units, and it does just doing the math there. And it doesn't surprise us that it's more than 400 units because now we're trying to cover a profit, aren't we? And it's what? $20 contribution margin per unit, 100 more units. Bam, gives me what? The $20,000 of profit I'm looking for, right? Okay. Okay, good. Now you come over and we show you that same format now where now we're putting in 500 bikes at $500 a piece. That's 250,000. The bikes cost us what? Variable cost, 300 to produce those, so that's 150. We now have what? We now have 100,000 contribution margin, of which 80 covers fixed costs, 20 left over to go to profit, right? Is that 20,000 profit operating income good enough for you? Me either. I don't like it either. I want more than that. 20,000. What are they trying to kill me? What do they want to do? See me weep openly? 20,000. So, how much you want to make? Couple mil, you say? What was your name again, sir? What was your name again, sir? Huh? Dow, you want to make 2 million, you say? Okay. So we're going to put 2 million. Hang on, we can do it. 2 million plus what? 80,000 is my target profit, isn't it? I mean, will give me 2 million target profit, and I set that up equal to what? I set that up equal to, I don't know, is there an eraser in here now? So I want what? 2 million plus 80,000, you say? That's my fixed cost. Here's my target profit. Here's my fixed cost, right? Okay. And I'm going to set that up equal to my target profit units times my contribution margin per unit, which in this little example is how much? 300? I mean, excuse me, 200? 200. So I go ahead, come up with my 200. That was my 500 sales price minus my 300 variable cost, right? Just to remember how we got that. Gives me the 200 contribution margin per unit, right? That's what that is. Okay. So now I just have to do the algebra, don't I? So I take this what? I take my target profit units, which is what I'm looking for here, is equal to 2,080,000 divided by what? Divided by the 300. I mean, excuse me, 200 contribution margin per unit. How many bikes are you going to be making? 10,400 bikes? Okay. 10,400 bikes. Can you do it? 10,400 bikes? How many bikes per that is that per month? 10,400 divided by 12 is what? 867 bikes, because you can't make a 0.6 of a bike, right? So 867 bikes a month divided by 30 is how many? 29 bikes a day got to be coming out of that place, right? Right? So what do? You maybe set it up for a couple days and see. And if you're making 5 bikes a day, and at the end of the day you're laying down, geez, I didn't even sleep today, right? Then 29 bikes a day ain't happening, right? Well, but you got to be able to make the bikes. If you're sitting there and you don't have the capacity to make 29 bikes a day, I don't care. You could have the best ever. In fact, our sales people are going to be mad at us because we can't keep up with their sales, right? So we could have Trump selling the bikes for us, whatever, right? Telling everybody it's going to be the best bike in the world, and everybody's okay. I'll buy one, And now, if we can't produce the bikes, we ain't going to make the bike. We're not going to be able to make them, right? So we got to be able to make them first. Oh, I don't know. If it's per month in this problem. If they're talking per month, that's fine. If it's 80,000 per month, we'd have to multiply the 80,000 times 12, right? Is that what you were going to answer?
No, I answered.
You answered your own question? Okay, good. As long as you don't argue with yourself about the answer, you're okay. Although I argue with myself all the time. Okay? Yeah, it may be that they were talking about a month here, and I'm just trying to flip it into a year, whatever. Whatever the period is that you're looking for here. If they had told me it was a month, and then somehow they asked how many bikes do you have to produce in a year, then you'd have to multiply everything by 12, right? Okay? Okay, good. So let's go ahead and let's take a look at some potential questions about our contribution margin approach here. And if the break-even in units will decrease if there's an increase in what? Selling price, right? Okay, let's go ahead and try it. So we have $600 is the selling price now. Instead, I'll make it $550 just because I don't want it to be $300 and $300. $550 is the selling price of the bikes. What's the What's the variable cost per bike? 300 is the variable cost per bike. So now I have a contribution margin of what? 250. And if I go ahead now and I say 250 times break even units, and you're going to get tired of me always setting it up like this, guys, because I don't like to jump straight to a formula that I've got stuck in my head because I might forget the formula, right? And so you always want to sit there and do what? Think through what you're doing. I'm just simply trying to come up with the break-even units here, and I got to set that equal to my fixed cost, which is the problem that we were using. I think they were saying it was 80,000, right? Right? Hello? Okay. And so if I take the 80,000 and I divide it by what? $250, now my contribution margin per unit is more, isn't it? Because my sales price went up. What's my break-even units? 320. We didn't lie, right? It went from what? From 400 down to 320. The break-even units decreased, didn't it? Okay. Question? Okay, good. Let's go ahead and let's take a look at this one. And some of these problems, the way the textbooks show the solution, it's kind of like, okay, why would you do that unless you just had time to kill during an exam and wanted to entertain yourself, which I don't think will be the case, okay? But let's just take a look, and we say that Breeze Inc., a company that produces and sells a single product, has provided its contribution format income statement, and we have our sales, our variable expenses, and our contribution margin of $55,680. We take off our fixed expenses, and they're telling us we have operating income left of $7,100. If we sold 5,800 units, what would be the contribution margin? Now, when you look at this solution, they go ahead and they take the 136,000 of our sales price and they divide it by the number of units that the problem told us they were making up there, that's 6,200, and that gives me what? $22 per unit is my sales per unit, right? Okay. Then they do the same thing with the variable expenses. 80,600 divided by the 6,200 units is $13 per unit for my variable cost. And then they take the what? Selling price per unit minus the variable cost per unit gives me a contribution margin of $9 per unit, doesn't it? Right? And so if I have a contribution margin of $9 per unit, and they tell me, well, what if you sold 5,800 units? What would your contribution margin be? And you can see down there the solution was what? Was that they went ahead and gave me this solution right here, which was this 52,200 was the answer, right? Because they told me what happens if you produce 5,800 units. Now, that's sort of the, I don't know, long road way of doing it. The way I do it when I look at this problem, I say, well, look, if they already showed me that the contribution margin is 55,800, didn't they? Right? And they're telling me that that's what it is when you sell 6,200 units. Can't I just take that 55,800 and divide it by the 6,200 units? And doesn't that give me $9 per unit as my contribution margin per unit? Hello? Get the same way and I don't have to make 3 different calculations, right? The more calculations, the more numbers you got to pipe into your calculator, the more the chances you're going to hit divide when you meant to hit times or something stupid like that, right? Okay, so I have this $9, and again, they're saying, well, what would the contribution margin be if you only produced what? 5,800 units. Answer is the same answer, 52,200. That's the way I like to do these problems, rather than sit there and do, here's my sales price minus my variable cost, gives me my contribution margin per unit. etc., right? Why would the company want to know what their contribution margin is if they're only going to produce 5,800 units? Why would they want to know that? Huh? I mean, why don't they just go ahead and produce 6,200 units? Something's gone on. There's been a drop in the capacity to produce those 6,200 units, or maybe they're considering it just for this product. They want to see what the contribution margin will be, and with the excess capacity that they've freed up now, they can produce some other product, right? And see what the contribution margin is that, and add that together. And if that's giving me a higher profit, then I'm going to go with that option rather than just producing the 6,200 units, right? Okay, so as I was saying on Wednesday when we were getting ready for this chapter, in my opinion, this is the most important chapter that you're going to take in this class, because this is the kind of analysis that when you're transferring to the university and you're coming out with your degree at the university, they are expecting a business major, whether you're an accountant or not, they're expecting you to be able to hang with this kind of analysis, aren't they? And I don't mean hang like this kind of hang. I mean hang in a good way, right? With this type of an analysis. And the last thing you want to be is the person that, you walk out of the meeting and they're saying, can you believe we had to explain that to John again? Isn't that the third time we've talked to him about that? Pretty soon they stop inviting you to the meeting, don't they? Okay, so you want to be, involved and be a valuable member of your team, etc. You need to be able to think through these type of analysis. Okay? Okay, good. Any question? All right, good. Let's take a look at this one now. And for this one, they're telling me that a company sells 4,700 units. Its total contribution margin would be closest to. And again, guys, I would come up with the contribution margin per unit, which they say the contribution margin is what? 83,600, and that's when they're selling how many? 4,400 units. So if you take that $83,600 and you divide it by the 4,400 units, you should come to a $19 per unit contribution margin. Right? Okay. Once you get that $19 per unit contribution margin, then you just do what they did down here, which is multiply that by the number of units that they said they were going to sell, which is what? 4,700. So the contribution margin should be 89,300, right? Okay. Again, they went ahead and they first gave me the sales price per unit. They gave me the variable cost per unit. Then they came up with the contribution margin per unit by subtracting the variable cost per unit minus the sales price per unit, gave me contribution margin per unit, and then they did this calculation. And by the time you get to there, you have given yourself 1, 2, 3, 4 chances to mess up the calculation in there, as opposed to what? 2? So we cut our calculations in half, don't we, doing it this way? Less chance you're going to mess something up with your calculator. All right? Okay, good. Come over and let's take a look at this one now. And this one wants to see if we can compute our break even in units. Do we know how to do that? We're taking and they're being nice to me. They're giving me the the variable cost and the sales price per unit on this one. So it's 230. That's my sales price minus what? My variable costs, which are 66.70. That gives me my, what do I call that? Contribution margin per unit. Contribution margin per unit now is going to be what, 163.30? $163.30. Then I set that up, and again, you're going to get annoyed with me because I'm always going to say, okay, my contribution margin per unit times my break-even sales. Got to equal my fixed cost, doesn't it? So I'm going to take 163.30 times my break-even sales. That's the unknown here. I don't know what that number is. I'm going to try to figure it out. Is going to equal, and they told me the fixed cost is 212,290. Good. So now I take that 212,290 and I divide it by 163.30, right? My contribution margin per unit, and that should give me the break-even sales here of 1,300 units. Aren't these fun? I'm thinking next Sunday you invite your friends over to watch the football game, but everybody's got to sit down and do a few of these problems with you, right? Then you'll be sitting by yourself in your big house watching the football game, right? Okay? All right. All right, let's go ahead and let's take a look at this one now. And they tell us that we have a selling price of $40 per unit, variable expenses of $22 per unit. Same thing, isn't it, that we just did? Okay, so you're saying, why are you making me do this again, John? Because this is what they call practice. Okay, and so what happens? We have our $40. We take off our $22 of our variable cost. Contribution margin is what? $18 per unit. We set that up as our contribution margin per unit times my break-even sales that they're asking me for here. And that's going to equal my fixed costs. They tell me that the fixed costs are what? $82,800. I know that my contribution margin per unit is how much? $18. I'm going to set that equal to my break-even sales. I divide each side by what? $18. So if I take that break-even sales then in units now is equal to 82,800 divided by what? By the 18 bucks, and that gives me 4,600, I hope. Is that the answer? Okay. Okay, good. Let's see. Another one? This one's got what? This one's got target profit in it, doesn't it? Got target profit in it? Okay. So all I got to do is add the target profit to the fixed expenses, don't I? Okay. So what's my first, let me get my contribution margin per unit is going to be this 190 minus 9120. What's that? 98.90? $98.90. 98.80. Is that what you said? 98.80. Okay. So we have this 98.80, and we're going to go ahead and we're going to set that up, the contribution margin per unit, times my, and now it's target profit sales, right? Equals, and what's the fixed cost? 424,840 plus what? 16,000 target profit, right? Right? Okay. So I go ahead and I set that up as now 98.90 times my target profit sales. Got to equal, what's the total of those two? 16,000 plus 42480? 440,840? Good. That's my what? That's my fixed cost plus my target profit, right? Right there. Okay. And I do what? Now to get my target profit sales, I simply do the algebra, do the math. Now the algebra is done. I've set it up. I just do the math, which is 840. Divide that by what? 9890. And that's going to be equal to this 4462 units. Right? Okay? Okay, good. All right, so let's see how we might graph this whole idea of break even and this idea of profit, etc. And so you see we have our fixed costs, right? Our fixed costs are going to stay the same no matter how many units we produce, right? Then what are we going to do? Then we're going to bring in our variable cost, and that's going to bring up my total cost line by the number of units I produce, right? For every unit I produce, I'll have an additional cost, and so that'll bring my total cost line up. Then what? Then I lay my sales line on top of that, and of course, if I don't sell any items, my sales zero. The more items I sell, the more my sales goes up, right? Okay, and so if you graph these across each other here, you can see the loss area down here is before I have covered my total cost. And then once I have covered my total cost, which is what? My variable cost plus my fixed cost, at some level, I have now covered all my fixed costs, and I do what? I start making my profit, don't I? Okay. Question? Okay, good. What we're going to do is take the break right now, because I think part of the reason we've been finishing so early is I've just kind of blown through the break time. So this is probably a good time for us to break real quick. Take maybe 10 minutes. We don't have to overdo it. Make a quick 10 minutes, okay? And we'll come back and we'll talk about contribution margin ratio, okay? What, you don't want to take the break? Okay. Yeah, let's take a break. We'll take a break. We'll come back at, let's make it 25 after, okay? Okay, guys, let's go ahead and get started back after the break here. And we have been using our contribution margin per unit to come up with our break even in units. And then you saw in that one example where I said if you actually wanted the break even in dollars, you'd have to take the break even in units. I think it was what, 400, and multiply it by the sales price per unit to get the break even in dollars, right? Well, there is a shortcut to coming up with the break even in sales dollars. It is something called the contribution margin ratio. And with the contribution margin ratio, we're simply going to take our and notice that our sales, if it was at 250, that's 100% of the ratio. Our variable cost being $300, that's constituting what? 60% of the ratio. So our contribution margin ratio would be our contribution margin divided by what? Divided by our sales, right? And that gives us a ratio which is telling us what percent of each sales dollar goes towards what? First fixed cost and then profit. So we're, instead of just coming up with a price per unit, we're coming up with a percentage per unit, okay? And we can calculate that the way they have here using the total contribution margin, dividing that by the total sales price. the way I tend to do these is I go ahead and do them per unit. So I take the contribution margin per unit divided by the sales price per unit. You come up with the same answer, don't you? 40% contribution margin. What is this? Contribution margin ratio, right? Okay. Now that I have that ratio, what can I do? Well, first, I'm showing you the way I showed you earlier, which is to take your $200 contribution margin per unit times your unknown break-even units. We go ahead, we divide each side by the contribution margin per unit. That tells me I need to produce 400 units, and then I multiply it by the $500 per unit. I get the $200,000 break-even sales, right? We already looked at that. But what I could have done was take my fixed expenses and divided that by the contribution margin ratio, and I'm telling you to set that up as break-even sales dollars times the contribution margin ratio equals fixed cost, because we're saying 40% of each sales dollar first has to cover what? Fixed cost, and then we can do the target profit as well. And so if you divide each side by 0.4, you get the same answer, don't you? That your break-even sales is going to be 200,000. So it's just a way to allow us to generate what? The break-even in sales dollars, rather than have to do the units and then multiply it by the dollar per unit, right? Although we could do it that way as well, but I'm just showing you a shorter, quicker way to come up with the sales in dollars here. Okay? We call that contribution margin ratio. And if it's target profit, then we simply do what? Then we just add the target profit to the fixed expenses, and that's going to give us now our sales dollars, right? Question? Okay, good. So let's try a couple questions now using the contribution margin ratio then. And we come over and we see that they're just calling out the contribution margin ratio to us here. We don't have to calculate it. They just gave it to us, didn't they? Okay. And they say that what? The monthly fixed expenses are $44,000, and they want to see that if the company has sales of $299,000, what's going to be our operating income? So notice what they do. They sit here and they say, well, look, if I have sales of $299,000 and 16%, 0.16 is my contribution margin ratio, that means 16% of every sales dollar is going to fixed costs, and then anything that's left over will go to profit, won't it? And so if you go ahead and you subtract off then the fixed cost off of that, you know what the profit is that you'll make if you have $299,000 of sales, right? Question? $299,000 of sales, 16% of each sales dollar goes to first fixed cost and then profit. So I figure out, well, $299,000 of sales times 16%, that's the amount that's going to go first fixed cost and then profit. I take off the fixed cost, I know what my profit's going to be, right? Okay. Okay, good. Let's try another one. This one, they're going to give me the sales, the variable expenses, the fixed expenses, and they want to know the break-even in sales dollars. Now, you're sitting here saying, well, John, couldn't I just figure that out per unit? Yeah, if they gave me the units. This problem didn't give me the units here, right? So I'm going to have to use my contribution margin ratio. And so what happens? I go ahead, I figure out my what? I figure out my contribution margin. Right? Sales price minus my sales minus my variable costs. Right? That gives me 480,000 contribution margin. I divide that by my sales. That means I have a contribution margin of 0.8. Do you like that contribution margin? Do you like that contribution margin? I think that's pretty good, right? 80 cents of every dollar is going towards my fixed cost and my expenses. I should do what? I should get over that fixed expense hump pretty quickly, shouldn't I? Okay? Of course, it depends on the size of my fixed expenses. If they're really big, then it's going to take me a while to get over my fixed expenses if my fixed expenses are really big. But once I do, that's when everybody wants to jump on board with my company, right? If they're sitting there and saying, you know, this company is what they call highly leveraged. They have a lot of fixed expenses, but man, they've covered those fixed expenses, and after that, it's all profit, isn't it? And it's going to go up quite quickly because my variable costs are what? Such a small part of my overall fixed costs. I mean, of my overall sales price, I should say. Okay, now you come over and you take a look here. Now, the other problem with this is if I'm in a loss situation, then it's going to take me a long time to break even, right? So you want the company that's already broken even to have a cost structure like this, don't you? Okay, but then what happens? We have this 0.8, and again, the way I set them up, 0.8 times break even sales. Am I looking for units or dollars now? Dollars, right? Has to equal what? Has to equal my fixed cost of 300,000. And so now you can do that math. That means my break-even sales is 375, right? Again, guys, you may think, John, that's a little overkill. I believe that the more times you write it out like that and think about it like that, the easier and easier this stuff gets. If you kind of jump to this because you're understanding it now, but remember on the test, you're also going to be saying, how do you handle the high-low method? How am I going to sit here and do my predetermined overhead rate with my underapplied, overapplied? And all of a sudden, that brain space is not quite as efficient as it is right now, right? So you're better off, in my opinion, of thinking through the logic. I think it's going to save you time in the long run. Okay? Okay, good. Come over. And let's look at this one. And we want to know what amount of contribution margin will come up if sales increase by 30%. Okay? Now, first thing we have to do is figure out what is the contribution margin ratio here. And that's not too bad. It's what? $8 divided by $20? Everybody see how I got that? Hello? Okay. So that gives me what? 0.4 here? Okay, is my contribution margin ratio. And then they say, well, if sales increases by 30%, well, what happens? Well, if sales are at 300,000 now, then to increase my sales to 30%, I would simply take 300,000 times what? 1.3? Does that increase at 30%? The one part is giving me what? Is giving me 300,000. The 0.3 is giving me the 0.3 increase, right? Right? Okay. And so what do I get? 300 and what does that come to? 390,000? 390,000? Everybody see how the logic worked there? You sure? Don't be embarrassed to ask. I've had students have trouble with that before. So we're good? 390,000, how that's increasing at 30%? Okay. So if we have 390,000 and what? 40% of each sales dollar first goes to fixed cost and then to my profit, that means I have a contribution margin of 156 here, don't I? Right? What if I told you that the fixed costs were 56,000? What's my profit? Huh? I would take off my fixed cost of 56,000. I have 100,000 left to go to profit, don't I? Right? So now we're getting into a situation where we are able to use this contribution format to help us to get a sense of, well, what happens if this happens? What happens if that happens? And sometimes you can use the contribution margin for that. Other times, guys, I'm of the opinion that the fact pattern is complicated enough that you're better off just writing your whole contribution margin statement down and seeing the way the different factors will change your outcome, whatever it is, your profit or whatever it is you're trying to analyze. Okay, so let's just take a look at a couple of scenarios here where that's what they do. And so these folks are sitting here in the hallway, I guess, talking about, well, what if this, what if that? And so we're sitting here and we say, well, what if the profit impact, if the racing bicycle can increase unit sales from 500 to 540, but to do that, we're going to have to increase the advertising budget $10,000. So we got to increase our advertising budget $10,000. We think we can sell 40 more bikes. Do you want to do this? And when we're doing this, we're talking in the hallway. That lady's his boss, and she's asking him, what do you think? He wants to quickly figure out what the heck's going on, right? Now, if that's the case and your boss says that, what do you say to them? Let me get back to you. Right? So you can go and you can do you can sort of write it down and make sure you get the right answer, which is what? We go from 500 bikes to 540. That means we're going to have 270,000 in sales. But of course our variable costs are going to come up because we have to produce more bikes now, don't we? 40 more bikes. So we have a slightly higher contribution margin ratio, $8,000 higher, but we increased our advertising by 10,000, so our fixed cost went from 80 to 90, didn't it? So we only got an $8,000 increase in our contribution margin and a $10,000 increase in our expenses. That's a big no on that idea, isn't it? Right? Now, you could sit here and do it this way, where you're saying, well, look, my contribution margin per unit is $200. I'm going to produce 40 more units, so I got what? $8,000 more coming in, and I'm going to increase my expenses by $10,000. That gives me the same no answer, doesn't it? Okay, so if you have just sort of one variable changing like that, you could use a contribution margin. We're going to see in a couple of examples coming up that, we're going to have a couple of different variables changing, and the takeaway from that is not how you use the contribution margin unit per unit, etc., to figure it out. The takeaway from there is how handy the contribution margin format of our income statement is for making those sort of analysis. But you're still going to have to sit there and write something out pretty detailed, but still it's a different format. So is this guy going to cross the street or not cross the street? Huh? I guess he decided not to cross the street, right? My question is, how did he get himself out there in the middle of a freeway like that? But okay. All right, so eventually he's going to have to cross the street to get out of it. Okay, but he decided not to cross it. Okay? All right, so let's go ahead and let's take a look at this one now. And we say, what is the profit margin if racing bikes can use a higher quality raw material, thus increasing variable cost per unit by $10, and now we're going to increase our what? Our sales from 500 to 580. Okay? And so we come over, and let's just take a look at the contribution margin format for our operating statement. There's our scenario that we've already seen where we have the 20,000 profit at 500 bikes. We go to 580, we're going to do what? Increase our sales, right? And when we do that, we're going to have a little bit higher variable cost now, and we'll have our contribution margin take off our fixed expenses. That sounds like a good idea, doesn't it? Okay. Okay, good. What did our contribution margin go down to? It went from what? From 200 to 190? Right? It went from 200 to 190, but then what? Our volume came up enough to cover that difference, right? Okay, good. Come over. And let's take a look at this one, and we say, what is the profit impact? If we cut the selling price by $20, increase the advertising budget by $15,000, and increase sales from 500 to 650. And so let's take a look at that. And again, the takeaway here is how the contribution margin format will help us. They cut the sales price, didn't they? So our sales came down. Our variable expense per unit stayed the same, although we've now produced more units. So our contribution margin came up, and our fixed expenses went up a little bit, and we pulled off $2,000 here, didn't we? Would you do this? You would? In textbooks, they would say, you should do it because it increases the profit. Would you do it if it was your money that was at stake? I'm not doing this. I'm looking at this and I'm saying, you mean I got to produce an extra 150 bikes, hope that I sell them, and if I do sell them, then my grand reward is going to be $2,000 at the end of this? No, thank you. I'm not doing that, right? That's just not too much. If I'm going to take a risk of being stuck with 150 extra bikes that I might have to sell for $300 a pop, just cover my variable cost on this, that's not worth it to me because now I ran this stupid advertising campaign and I lost the money on the advertising campaign, didn't I? So I'm looking for a little more cushion than that, than $2,000 to make this worth my while. In textbooks, they would say, yes, you should do it because it increased, right? Okay, good. How about this one? We have an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses. What price would it quote to the wholesaler if it wants to increase monthly profits by $3,000? Now, what's happening? We're assuming that we have already broke even. We've already broke even. And now we have somebody who wants us to add some additional bikes to sell them. We're saying, what can we sell them those bikes for if we want to increase our profit by $3,000, right? So what's happening? We come over and we say, well, look, we have to cover at least $300 per bike, don't we, our variable cost? We know we have to cover that. But now we're going to take the $3,000 extra profit we'd like to make, divide that by the additional bikes, and that's $20 per bike, isn't it? So if we sell that bike for $320 per bike, we'll make the extra $3,000 that we want, won't we? Okay? Now this is assuming a couple of important things. The first thing it's assuming is we have factory capacity to make an additional 150 bikes. If we're tapped out in terms of our capacity, we're done, right? We can't sell any more bikes at this point, right? So we'd have to have the capacity to do that. What else are we assuming? Okay, that our fixed costs stay the same. And remember, we say fixed costs stay the same within the relevant range, assuming we're not going to have to add another factory building or something like that, okay, to increase our capacity. So our fixed costs are staying the same. Yes, that's a big assumption. You're right. Any other big assumptions going on here? What were the other people buying the bikes for? What were we selling the bikes for before? We're going to sell these bikes for $320 a pop. What were we selling them before in all of our analysis? Well, there was one that was $480, but we also had a $580, didn't we? I mean, $500. It was $500. If you were buying bikes from me for $500 and you found out that I was selling the bikes to somebody else for $320 a pop, what would you say?
Why you sell me in
What did I do? What did I do? Why do I go on? Okay, can you give it to me first? Yeah, I heard. All right, if this gets out, right? So you got to.
I thought you're pricing it out in your quantitative pricing.
That would be my response, right? If I'm charging you $500 a bike, but all you're buying is 10 bikes from me, right? I'd say, well, I'll tell you what, I gave it to, Bikes, We Are Bikes, whatever, the company that sells the bike. I gave it to them because theirs bought 150 bikes. If you buy 100, I'll give you this deal, whatever, right?
Why would you say 100? 150.
Well, whatever is needed to make it work for me, right? I'm just saying we want to make them feel like we're treating them like kings and not the other people, right? Him, I made him give me 150. For you, 100 bikes. See how you phrase that? Okay. Okay? All right, so let's go ahead. And the only thing that comes up in this slide, guys, is you'll see some questions where they might give you the variable expense ratio. And you're going to be like, variable expense ratio? How can I come up with a contribution margin ratio of that? Well, if they do, you just take what? The 100%, which is my sales price is 100% of my sales price, obviously. And if you back off, you subtract off the variable expense ratio, you're left with the contribution margin ratio, right? And I just point that out because there could be a question, like this one, okay, where they go ahead and they tell me what? They tell me that my variable expense are 35% of sales. Can I come up with my contribution margin ratio? 1 minus what? 0.35 gives me 0.65. Give me so far? Okay. And then they say if sales increase by 75,000, what will happen if we have an advertising campaign of 25,000? So what are we going to do? We're going to go ahead and pick up the 0.65 times 75,000. That's giving me my contribution margin, the increase in my contribution margin, isn't it? Right? And that comes to what? Anybody got a number for me? 48,750. And then I simply have to go ahead and subtract off my advertising campaign increase, which is 25,000. Essentially, I've increased my fixed cost, haven't I? And that gives me what? 23,750. There it is. Right? Okay, good. Come over and let's take a look at this notion of sales commissions. I'm going to have to start learning how to dance or sing or something. I'm always anticipating more questions about this, and you guys don't have them, and we're going to get out early again. What do you want me to do, dance or sing? You're looking at me like, dude, neither. I don't think so. Because if you could do either, you wouldn't be sitting here, talking to us about contribution margin ratio, now would you? Okay? All right. So, and you're right. That's a good observation. Okay. So, anyway, let's go ahead and take a look. And we say that companies generally compensate salespeople by paying them either a commission based on sales or a salary plus a sales commission. Commissions are based on sales dollars and can lead to lower profits in the company. So what happens? We tell the guy, for every item you sell, we'll give you a 10% commission, and that'll add to your salary, or that is your salary, right? If you're that salesperson, are you going to sell the higher cost items or the lower cost items? Higher cost, because you just hire 10% of a bigger number is more money in your pocket, right? Okay. So what happens? Well, that could hurt the company if, and you look at this one now, this is surfboards now, and they have the RX-7 and the Turbo. RX-7 sells for 100 and generates a contribution margin of 25. The Turbo sells for 150 and earns a contribution margin of $18. If you're the salesperson, which one are you pushing? The 150. Meanwhile, it contributes less to the fixed cost and then the profitability of the company, doesn't it? Aren't we kind of messed up here? So what would you do? How would you change this up? How would you change this up to get the desired result?
On dollars sold, not units sold.
Still dollars sold. I mean, if you sell one bike, and his commission is 10%. 10% of 150 is going to be more than 10% of 100, right? Right?
Yeah, but if you're doing it on dollars sold and he sells 150 and 100, that's 250, that's 25, not.
If, huh? No, if he sells 100, just do it with one. He sells 100 And if his sales commission is 10% of 100, he's going to get what? $10, right? Right? If he sells if he sells one for 150 and he gets or she gets 10%, that's going to be $15, right? So he wants to sell this one that gives him $15, doesn't he? Right? Meanwhile, the contribution margin to the company for the one for $100 was what? Was 25. Meanwhile, the contribution margin of the company for the one that was 150 is only $18. So he did better, but the company did worse, didn't they? Okay, and that would be the same 1 unit, 2 units, whatever, right? Okay. So what else might you do?
Change the percentage to the contribution margin, not the sales margin.
Set it up on contribution margin, right? And you tell the guy, look, we'll give you more money to sell more of the other bike that has a higher contribution margin, right? Okay, and so you come over and you take a look, and that's what they tell us here. If you were on the sales force at Pipeline, you would push hard to sell the turbo bike. To eliminate this type of conflict commission, you can base it on what? Contribution margin. Isn't that what they're telling us? What's happened to our customer service now? What's happened to our customer service now? I mean, we could sit there and realize that VCRs have the better contribution margin, right? And say, okay, get everybody to buy a VCR. Is that a good technology to sell to somebody these days? No, right? We'd be much better off to say, well, don't buy that. Please, you want to buy this one over here, right? Okay. So I can see the wheels turning. You're going to go into Best Buy today to buy something. Say, what's your contribution margin on that, huh? Why are you trying to sell me this one instead of that one, right? Okay, so at some point, you have to be a smart customer, don't you? A smart consumer to realize, do your research to realize what the better technology is for your purposes, et cetera, right? Because the company they don't wake up in the morning saying, how can I make sure that someone's getting the best deal all the time? That should be their approach, and a company that does that is going to be in a much better strategic position than a company who makes only decisions like this. But this certainly can be a factor, factoring out customer service, and that this certainly can be a good analysis, right? Okay. Questions? Okay, so I have some work to do, which is to put up on Canvas for Wednesday a batch or two of questions for us to go through next time. Okay, so look up there, probably unfortunately, early Monday before you're coming to class. Take a look up there on Canvas, and you'll see that I will put probably maybe at least 1 and maybe 2 Word files, maybe having about 30 or so questions each to be like our midterm. Okay, and what we're going to do starting Wednesday is start all the way back and with Chapter 1 material, Chapter 2 material, Chapter 3, Chapter 4, Chapter 5 material, all in one file. And we're going to sit here and we're going to go through all those questions, right? And so it's probably not a bad practice to go through the slides for those chapters where I've embedded the questions, see what the questions are looking like there, get yourself ready to be able to answer those, and you'll be able to answer the questions into this sort of practice midterm drill we're going through.
Starting next Monday or next Wednesday?
Today's Wednesday, right?
Monday.
I mean, Monday, right? So I'm talking about Wednesday.
This coming Wednesday.
I'm talking about the day after tomorrow. Yeah, you'll see files up there that will have instead of 1 per chapter, 1 set of questions all from 1 chapter, several chapters, just like the midterm's going to be, the 5 chapters. Okay?
Yes, sir.
Okay, guys, we'll see you on Wednesday. Have a good rest of the week, rest of the day, and we'll see you on Wednesday. Yes, sir.
That'll be about a month of practice.
You want to take the test sooner?
No,